ever asked yourself, what is a profit and loss account and why is it important? Hi, I'm Kim Marler from Crystal Clear Accounting, and I often get asked this. So in this video, I'm going to answer that question. A profit and loss account, in essence, is a summary of the income or sales of a business, often referred to as the turnover, less all the costs incurred by the business over a period of time, usually a 12-month period. I do need to caveat this and say a P&L statement can be manipulated and can be fiction. Of course, you do have to follow UK GAAP when producing the P&L for the annual accounts for HMRC and Companies House, but most SME business owners do not even have to submit a P&L to Companies House. If you meet certain parameters about turnover, numbers of staff and/or asset base, you do have to file a full set with Companies House, and they're subject to an audit. But it's usually for much larger businesses, usually turning over 10.2 million or with around 50 employees or assets worth 5.1 million. So a P&L account takes you from turnover at the top, then you subtract all the cost and sales and overheads to arrive at the profit at the bottom. Most business owners just scan their profit and loss account and just pay attention to the profit at the bottom. There is, however, so much more to the P&L account than that. So let's look at the numbers you should be taking note of from your P&L account. How much money has the business generated from the sale of its products or services? It's important for the business owner to understand what's driving this figure. Has the business grown over the last year by bringing in more customers? Or have they just sold more to their existing customer base? Or have they increased prices, or a combination? This is quite important to know as it will have an impact on gross margin, but more about that in a minute. If you manufacture a table and sell it for £100, but the cost of the raw materials you buy in is £50, then the value you've added during the manufacturing process is £50, or a 50% gross margin. So the gross margin and gross margin percentage for the business has to be enough to pay for the running costs or the overheads of the business, any tax, the salary, dividends of the business for the owner to live the life that they want. So actually, understanding the gross profit is a much more important number than the sales number. There is a saying that turnover is vanity, profit is sanity, and cash flow is king. So you could have a sales figure of £1 million, with your gross margin being 20%, which is 200,000. But if you need 200,000 to pay the overheads, then there's no profit left to either pay a dividend, invest in the business, or pay a salary increase to your team. So you'd need to relook at your business model in this instance. Gross margin percentage is really important, as if you increase your prices, for example, the increase flows straight through to the bottom line. This is because there was no increase in raw materials or cost of producing the product. So in our example, let's say we put up our prices of the table by 10%. So we've gone from £100 to £110. The cost of producing the table is still £50, but now the gross margin is 60. So it's the difference between the new sales price, 110, and what it cost us to make, which is still £50. So the gross margin has now gone up to 55%. You may have a range of products, all with different gross margin percentages. So if you sold more of your premium products than your normal products, then you'd expect the gross margin percentage to go up. So what is important here is getting your gross margin percentage going in the right direction, upwards. You will see a long list of overheads however you keep your accounting records, whether Xero or any other cloud-based software. Your overheads will typically be a long list of costs. These costs are anything from admin costs, premises, staffing costs, general costs like insurance, subsistence, entertaining, etc. The list goes on and on. Very often these costs can be a bit of a jumble depending on how they were originally set up. I'd recommend that you separate these out into main category headings like premises And all associated costs like rent, rates, heats and lights, etc. Come what may, you have to pay these. Even if you're having a bad month or year, you will still have to pay your rent and rates and your people costs, unless of course you downsize your premises or you make people redundant. So it's really important you know your business is generating enough gross margin to cover these overheads. Some of these costs typically don't change massively month from month, as they're usually fairly fixed. For example, most people's salaries don't change massively from month to month unless there are large amounts of commission and bonuses. An important cost to pay attention to is marketing. Very often you will see most accountants putting marketing costs into overheads. They will just lump them all into one general marketing budget. I personally like to see marketing costs shown in cost of goods sold, as it's a genuine cost that is only spent in order to make a sale. I also like to see the marketing costs split out in the bookkeeping software, so the business owner knows the return on investment from each different marketing pillar, rather than marketing as a whole. That way, they can spend more on one type of marketing over another, or at the very least, compare number of leads and conversion of customers by each pillar. If you have a limited amount of marketing budget, you can spend it in the place where you get more bang for your buck. It's important you understand your P&L account and the connection between all the figures. I always recommend that entrepreneurial business owners looking to grow and scale have management accounts produced on a monthly or at the very least quarterly basis. This way, they can see what is happening in the business and spot trends. I recommend they compare actuals to their budgeted figures, as this gives an early warning or alert when things start to go off track. These are called variances. It's really important to know why the variance has occurred. For example, your staffing costs could be increasing, but production remains static. This could be due to staff members are not as motivated, or it could be they are having to remake products due to inferior raw materials, which over time results in increased costs being incurred. It could, on the other hand, just be down to an increase in the national living wage. The important thing here is you understand why. Then you can challenge what needs to happen to change. Do prices need to go up? Is there a product which is not as profitable as it was and is now in decline, which is masking a more profitable product? All that needs to happen in this case is to switch production. I also recommend reviewing overheads on an annual basis, as there is often IT and software costs that you've signed up to that you are no longer using or are not as effective as it once was. When was the last time you looked in detail at your P&L and really understood what it was telling you and then took action to make changes? Hopefully, you can now understand your profit and loss statement a little more and can work on some of the numbers we've mentioned to increase your profits. If you'd like to have a chat over a coffee, virtually or face-to-face, and to see what's possible, all you need to do is call me or one of my team on 0161 410 0020 or email wecare@crystal-clear.co.uk. I hope that's helped. Please subscribe to our YouTube channel so you don't miss any of the content that we release. Feel free to hit like and share, and thanks for watching.